Hello and welcome to Live Wire Markets. I'm Ali Selby and today we're very lucky to be joined by QVG Capital's Chris Prunty for a look into how he's positioned on the back of reporting season as well as where he's finding the most opportunity within small caps today. Thank you so much for joining us today, Chris. We've obviously seen liquidity dry up in small and micro caps over the last 2 years. We've just come off the back of the August reporting season. Given that you really explore within that small and micro cap arena, how was reporting season for you?
Well, it was volatile. Lots of stocks moved up or down 10% on the day of their results, and that really tested your conviction in what you owned. Fortunately for us, we had more go-ups than blow-ups, and as volatile as reporting season was, it was a lot of fun. We love getting in front of companies, seeing their results, so it's like having 2 grand finals a year for us.
Have you made any changes to the portfolio on the back of those results?
There's 2 types of changes you make in reporting seasons. There's the natural portfolio moves you make around adding and taking away to positions as their prospective returns increase or decrease. And that's just normal course of business. The second type is more the oh shit moments where a result comes out and you fundamentally change your perception of the company off the back of it, and then you have to move more aggressively. The good news for us is this reporting season we didn't have any oh shit moments. It was more the natural trading activity as you readjust your views around future returns based on new information.
Okay, I definitely had an oh shit moment with one of my portfolio companies, so I'm quite jealous there. For you, what was the standout result from your portfolio?
From the stocks we owned, there's probably 2 I'd call out, Johns Lyng and Aussie Broadband, and the similarities were results came in line or ahead of expectations. Cash flows were very strong, which meant the balance sheets looked good, and the outlooks were in line or ahead of markets' expectations, and we feel like both companies have guided conservatively, so there's the prospect for upgrades through the year. So those were the 2 I'd speak to.
Okay, do you feel like those results will be sustainable over the next few years though?
Yeah, that's the other point. Johns Lyng and Aussie Broadband are both more or less economically insensitive, so irrespective of what happens in the wider economy, we think those results will be sustained. And they're both founder-led companies, which we also like.
I know you said you had no oh shit moments, but were there any companies that surprised you to the downside?
Yes, Data3 was down 20% in a day off its result, so that was a potential oh shit moment, but the nature of the business, the balance sheet, the cash flows were all quite strong, and subsequently that stock's reversed most of that 20% fall, so it was only a temporary oh shit.
Okay, what are you seeing at the coalface? Obviously you get to speak to CEOs every day, but particularly during reporting season. What were you seeing? What were they saying during reporting season?
Well, they were getting asked a lot of questions on AI. We didn't ask that question. I think it's too early to really know what that means. The call out I'd have, a more serious one, would be around hiring intentions. So our portfolio is very biased towards growth and growing companies, so you would expect those businesses to be hiring to support that growth. But I've never had more companies, either portfolio companies or just ones that are on our radar, tell me that their hiring intentions for this financial year are 0 or close to 0. So I think that's a really important call out for what unemployment looks like through the rest of the financial year, and perhaps that what the RBA is trying to do is working. We know employment is a lagging indicator, so that's something that was a call out for us.
Let's dive a little bit deeper into that. What could that mean for the interest rate cycle going forward?
Well, if it plays out as expected, then it means rates have peaked. I think the uncertainty around rates is that services component of inflation has been relatively sticky. We know the good side of it's come down, but the major feed through to services inflation is labour costs, and obviously minimum wages have gone up, quite materially. So that's still going to feed through, but in perhaps those middle income and higher income workers, we could see some dampening there.
Okay. Where are you seeing the most opportunity today, given that we might see unemployment rates rise? Where are you seeing the most growth opportunity?
Well, if that scenario plays out, then you really want to look for businesses that have an internal driver to their organic growth, so something they're doing that's unique to them, or they're selling into an end market that's above GDP growth. If you tilt your portfolio towards more economically sensitive or cyclical companies, then you'll probably do poorly in that scenario. So we have a very growth biased portfolio.
Do you want to take us through some examples?
Top 5 holdings for us, Johns Lyng and Aussie Broadband I spoke about. Hub24 is a big holding, Lavisa, and Life 360. And they're all quite different companies, but the commonality is they're all well above market growers, high incremental returns on capital, great balance sheets, and often those companies will look expensive to other managers, but we think the organic growth in those businesses justifies a premium valuation. So we have a heavy tilt towards strong organic growers at the top of our portfolio.
Obviously, there's been this almost crazy dispersion in returns within the small end of the market. What do you think needs to happen for both small and micro caps to rebound, I guess, as a group or as a unit?
Yeah, well, we've certainly been a victim of that the last couple of years. Smalls have underperformed their large cap peers by 20% over the last sort of 18 to 24 months, and even over the last 12, it's been about a 10% underperformance. So, we would love for that to reverse. What has to happen for that to reverse? It's probably going to be flow driven. So if interest rates peak, that will give investors more confidence that we've seen the valuation trough, and then it becomes very much about earnings for specific companies, and that's where most small cap fund managers should do well. They're typically as a cohort, we're good at picking earnings for our companies, but yeah, I think it's got to be flow driven, and I think it probably takes a bit of momentum to come back into the market. That will give people confidence to relook at that disparity between large cap and small cap.
But given we've seen, I guess, the RBA keep rates on pause yesterday, could we be closer to that scenario than we have been over the last few months?
Well, we certainly hope so, but we're not betting the portfolio on that. Our approach, irrespective of rates, is to go for organic growers, and in a tougher rate scenario or in an easing scenario, that organic growth will be the driver of returns.
Okay, well, I really enjoyed this chat today. Thank you so much for your time, Chris. If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.